Welcome back to your Mortgage Minute by onlendhub.ca. Today we are talking about something most homeowners set once and then forget: your amortization. In 2026, with the Bank of Canada holding at 2.25% and rates still well above your pandemic lows, amortization has quietly become one of the biggest levers you can pull to control your mortgage payment. We are joining by our mortgage expert Muli here. Muli, what do you mean when you say amortization is a cash flow tool, not just a number on your paperwork?
Amortization is simply the length of time your mortgage is scheduled to take to fully pay off. In Canada, the typical default is 25 years for high ratio insured mortgages and up to 30 years for uninsured borrowers. But in practice, you can shorten or extend that schedule at key decision points. By stretching or compressing that timeline, you are trading off lower monthly payments today against higher total interest over the life of the loan. And in a 2.25% policy rate world, where fixed rates are still around the mid 3 to mid 4% range, that trade off is sharper than most people realize.
So let's take a real example. Suppose someone in GTA has a renewal coming up this summer on a typical detached home. Can you walk us through the numbers on what happens if they extend their amortization versus keeping it where it is?
Take a homeowner with a $600,000 balance renewing at an effective fixed rate of about 4%, which is realistic in today's broker and bank channels. If they have 20 years left on the amortization, their monthly payment is roughly $3,600. If at renewal they extend that amortization back out to 25 years, the payment drops to about $3,200, a saving of roughly $400 every month or $4,800 per year in immediate cash flow. The flip side is that over the full life of the mortgage, they will pay tens of thousands more in interest. So the question becomes whether that $400 monthly relief is buying you breathing room or just funding lifestyle inflation.
That $400 difference is huge for families feeling the grocery and daycare squeeze. How do you help someone decide when extending amortization is a smart survival tool versus a dangerous habit that keeps them in debt forever?
I use a two-step framework. First, I look at their total debt service ratio, or TDS, which is the percentage of their gross income going to all debt payments, including the mortgage, lines of credit, car loans, and credit cards. If that ratio is north of 44% under the current amortization, then extending to regain breathing room is often justified as a stability move rather than a luxury. Second, I stress test their budget by asking whether they can commit to a concrete overpayment plan once their income or rates improve. For example, adding $200 per month or directing each annual bonus as a lump sum prepayment so that the amortization extension is temporary, not permanent. A red flag is when someone wants to extend to 30 years, cut their payment by hundreds of dollars, and has no plan or discipline to ever pay extra. In that case, they are locking in decades of extra interest for short-term comfort.
You mentioned lump sum prepayments and overpayments. Can amortization hacking work in the opposite direction? Someone who can afford today's payment but wants to accelerate payoff without locking into a shorter term?
Yes, and this is where the math gets powerful. Imagine a borrower in Milton with that same $600,000 balance at 4%, set up on a 25-year amortization, which gives them a payment of roughly $3,200. If their budget allows them to add just $300 per month, taking the payment to about $3,500, they can effectively knock 5 to 6 years off their amortization and save well over $50,000 in interest over the life of the mortgage, depending on how rates evolve at future renewals. Another version is to keep the payment at $3,200, but once a year apply a $5,000 lump sum prepayment. Over a 10-year horizon, that kind of discipline can cut your remaining balance by tens of thousands of dollars and give you the option to shorten your amortization at the next renewal.
Let's bring term length into this. We talk a lot about 2-year and 3-year fixed terms being popular in 2026, but how does the term choice interact with amortization when you are trying to manage risk and cash flow?
Think of term as the length of your rate and conditions contract and amortization as the speed of your payoff. In today's market, 2-year and 3-year fixed rates are often 25 to 30 basis points cheaper than 5-year fixed, and many economists expect the Bank of Canada to hold near 2.25% for much of the year, with only gradual moves after that. One strategy is what I call the short-term flexible amortization approach. You choose a shorter fixed term to avoid committing to today's rates for 5 full years, but you also set your payment as if your amortization were shorter. For example, using a 20-year payment, even though your contract says 25 years. So you are quietly building equity and protecting yourself against future renewal shocks. If rates do drop by your next term, you can then decide whether to formally shorten the amortization to lock in those gains.
What about investors or people with multiple properties? Are there any specific amortization pitfalls they should watch for when they are juggling rental cash flow and personal housing costs?
For investors, the main pitfall is using maximum amortization on every property to squeeze out the highest possible cash flow today without considering portfolio-wide risk. Longer amortizations do boost monthly cash flow, which can help your debt service coverage ratio on paper, but if rates drift up from these levels towards something like 2.75% on the policy rate, your future renewals could stack higher payments across multiple mortgages at once. A better framework is to match amortization to property roll. Keep your primary residence on a slightly shorter effective amortization so your housing cost declines over time, while using longer amortizations on rentals where the tenants are effectively covering the interest and then periodically rebalancing when you refinance or dispose of a property.
Before we wrap, give listeners one clear red flag where they should pause and get a second opinion before signing their renewal or refinance.
If your lender suggests extending your amortization to 30 or even 35 years just to make the numbers work without showing you the total interest cost and an exit plan, that is a major red flag. Extending amortization can be a legitimate lifeline, but if no one is walking you through the long-term interest impact and helping you set a timeline to shorten it again, for example, in 3 years when your income is higher or your other debts are gone, then you are being sold a payment, not a strategy. In a year like 2026, where rates are stable but not cheap, you cannot afford to make that decision blindly.
Let me recap 3 key takeaways from today's episode of Your Mortgage Minute. First, amortization is not a set-and-forget number. Extending it can save you hundreds of dollars per month in 2026, but only if you understand the long-term interest cost and have a plan to tighten it later. Second, pairing a shorter term with a disciplined payment, either higher regular payments or annual lump sums, lets you ride out today's rate environment while quietly accelerating your payoff. Third, any recommendation to stretch your amortization to 30 years or more without a clear exit strategy should trigger questions, not a quick signature. Thanks for joining us today, and we will see you on the next episode of Your Mortgage Minute.